And let me make this this comment. This meeting of the Senior Fund Commission is being conducted via Microsoft Teams and pursuant to Section 21-1503 of the Philadelphia Code. Electronic recordings of the meeting will be made available through the conference technology and via audio recording. Recording of this meeting will be made available to the public online at the Commission's website free of charge within 10 days. And please note that you consent to the recording by attending, participating, or speaking at the meeting. All right. The first order of business is the approval of the November Sinking Fund Commission transcript. Is there a motion?
Yeah, I'll make a motion to approve, Don.
Is there a second?
Second.
Motion has been made and properly seconded. All those in favor say aye.
Aye.
All right. Let me turn it over to Christopher for opening comments.
Oh, you're
We
on
can't
mute.
hear you.
Sorry, I've shared with all of you the November and December investment performance, as well as the market tracker. So I can share the documents. The agenda should be up on your screen now. Kwaku or Lee, are you going to start with the market commentary, or do you want me to put the December performance up? What document do you want to start with?
So, Chris, is it okay if we drive just that way? If we get any questions, we can kind of go back and forth between documents. Would that be all right?
Yeah, that's fine.
Perfect. So I'll defer to you guys. Since Lee has a cold, I think we've decided for the next meeting, Lee will do the driving and most of the talking, but for this meeting, just so he saves his voice, I'll do most of the jumping in. So with that, what would work for you? Would starting with November work best, or would December work best? We're fine either way.
I would say November.
November? Okay, perfect. So it's amazing, right? The time and just how November seems like a world away. But we'll discuss November, the market environment around November. We had an election. The market had a very strong reaction to the election outcome. And then December, kind of like the market does, there was a healthy degree of mean reversion and uncertainty about the year that we are now in. So some of the things that we saw in the month of November did retract a little bit in the month of December. But with that being said, let's start with November. Let's go through some of the key themes, what it meant for the portfolio. Ultimately, the portfolio continued to perform exceptionally well in the month of November. Year to date through December, very strong results. So when all is said and done, and we talk about volatility in the market, you can think about the Sinking Fund Commission, that portfolio holding up really, really well. So with the month of November, year-to-date results very quickly, and selfishly, I'm going to make this bigger for myself because if I cannot read it, I'm not sure if you guys can. But as we look across the major asset classes, equities comfortably in the double digits, high yield fixed income, so that's a component of the fixed income market correlated with equities, that's performing well, bank loans performing well, and really core fixed income, not a surprise here. It's the laggard asset class, given the fact that interest rates went up tremendously in 2022. And then there was really uncertainty around where Fed policy was going to go in 2023, definitely in 2024. That led to some volatility in the fixed income market, which we'll discuss momentarily. But fixed income did see interest rate cuts in September, also saw an interest rate cut in November, and that really drove these positive returns in the low single digits we saw in core fixed income. So as we think about the markets over the quarter period, so the 3 months ending November, again, really solid results when we think about the US market. Year to date, the US market in solid territory. The volatility that we saw in the global markets came more from the non-US side. So as we think about the non-US market, what are some of the headwinds that the non-US market faces that the US market wouldn't face? And you can think about currency. We have everything denominated in dollars here. If the dollar strengthens, that's not something that really affects the day-to-day life of someone here. Now, you think about a non-US investment, that's translated from one currency to the dollar. And if the dollar is more expensive, it costs more per unit of a foreign currency to get a dollar. That will turn a positive return into less positive or potentially negative. And if we look at the EFI as an example, you have the EFI local return, and then you have the EFI regular return. And the regular return is translated into US dollars. So as an example, a negative 1% result over the 3-month period, you convert that to US dollars being more expensive, that goes to a negative 6%. That's also the same if we think about the absolute returns year to date. 10.8% in foreign currency terms, 6.2% when we translate to US dollars. So just wanted to mention, that relative headwind that the non-US market has faced, that the US market has not faced, which is a strengthening dollar. The other thing that we've discussed at prior meetings is the dominance of technology in the US market. The so-called Magnificent Seven, your NVIDIAs, your Metas, your Alphabets, Teslas, and so on, these have really driven the returns of the US stock market. Now, if you compare the weighting of the technology sector in the US market versus the non-US market, the US market has around 40% in technology. The non-US market has around 18% in technology. So that relative weighting has also led to that pretty sizable performance differential between US and non-US. We then go into fixed income, and with fixed income, we see that the components correlated with the equity market, again, high yield, leverage loans, which are bank loans, these have performed pretty well because they have a healthy yield or a healthy coupon component. The market has been largely bullish in 2024. So the correlation of these asset classes has benefited them in this strong equity market. And then we think about your aggregate or your treasury fixed income. That's going to be more beholden to the Fed and interest rate policy. So you'll see volatility over the short term because, again, noise around, is the Fed going to cut? Are they not going to cut? Is inflation higher than expected? Is employment higher than expected? All of this noise leads to volatility in your traditional fixed income market where there's more sensitivity to interest rates. So positive over the year-to-date figure, but then little volatility over that 3-month figure. So PCE, we just mentioned, one of the indicators that the Fed looks at and one of the indicators that the market does respond to. In October, these numbers were in line with Fed expectations. So that was essentially seen as an okay thing by the market. And the market has, not been too surprising with respect to how it responds to inflation news. If inflation news is higher than the Fed projected, the market will typically sell off just because that should lend itself to higher rates. If rates are higher, it's harder to borrow. If it's harder to borrow, it's harder to spend. Harder to spend means less inflation in the system. And then if inflation numbers are where the Fed would like to see them, that does open the door for more interest rate cuts. The market likes interest rate cuts because lower interest rates means it's cheaper to borrow, cheaper to lever up, and the market likes that. So those are the trends that we've really seen bookended, throughout 2024 and really going into 2025. Job openings, very similar when we think about an indicator. In most normal times, job openings and job statistics, particularly on the stronger side, are a good thing. You want a working economy. A working economy means a strong tax base. But again, with this hyper focus on inflation, if job numbers are stronger than anticipated, you can expect the market to sell off. If job openings are a little shakier than anticipated, this is the strange thing. The market over the short term will view this as positive, but then over the long term will probably sell off because a slowing down economy isn't something to celebrate. So that's some of the noise that we've seen recently within the market. As we think about, yes.
Mike, let me just quickly jump in. Obviously, core CPI came out a few minutes ago for December and did come in, although it was up only 20 basis points, that was below expectation. And I think it called to about 3.2 on the year. So the probability of a cut, which was kind of non-existent in the short term, it has gone up a little bit again now. So just want to give you that hot off the press as you were talking.
Perfect. And to that point, if anyone checks their phone right now, everything is in green. Well, most things are in green with respect to the market. Growth is not in green right now. So, that correlation between the market, interest rates, and cuts, I think that's a really good real-time example that Lee just teed up for us. So market's rallying now. And as Lee mentioned, the inflation numbers came in a little bit better than the market was anticipating. So market's rallying for now. So wage growth, another indicator, wage growth, inflationary in nature. So at this point, we've gotten a sense of some of the key indicators that have shaped the market's reaction to interest rate policy. Now, the interesting thing here is, the love affair with debt. When we think about the economy, the shape of the economy, the U.S. consumer, just taking a look at spending around the holidays, you can see that there was still a bullishness going into, December and Christmas spending. If you think about the buy now, pay later programs, i.e. extending credit, that did tick up a little bit. And then as you look at overall spending, that was also higher than in previous years. So with everything being said, the U.S. consumer continues to do what it does best, which is, spend essentially. So that's also been a positive when you think about market sentiment and you think about the overall feels of the economy. Rate expectations. So this is for the month of November. We actually did have the 25 basis point cut in December. So the market was right with respect to its expectations around interest rates. And as we just mentioned now, it does appear that interest rate cuts, could be on the table for 2025, perhaps a little bit sooner than anticipated. Now, when we discuss December performance, we'll mention some of the economic indicators coming in a little bit higher when you think about inflation, employment being a little bit stronger, and that led to the market essentially selling off a little bit because there were concerns that rates would remain higher for longer in 2025. But again, this hockey puck that keeps on moving around, which is interest rates and where the Fed is going to place things, it does appear that right now rates could come down a little sooner than anticipated. So that's also a positive when you think about the market's reaction. Now, jumping into the performance of the various asset classes, we've discussed the broad macro environment. When we think about the various asset classes, you think about fixed income, the AG index, we think about intermediate fixed income, which is where we have a good degree of exposure. And, intermediate fixed income is going to have a shorter duration than your aggregate fixed income. So as we've seen volatility and we've seen rates go up, we've seen a little bit more speculation around where interest rates are going to go. The volatility around that has been less for your intermediate fixed income because the shorter your duration, the less volatility or sensitivity you have to interest rate movements. And just to point to how extreme duration can be when you think about market movements, think about long duration. It's about 3 times the duration of your market fixed income. Long duration for the quarter lost 3.5% in terms of government long duration. So a lot of sensitivity around interest rates, and that's led to, again, the noise that we've seen in the fixed income market. But where we are exposed is the more safe, the less esoteric, and the more plain vanilla segment of the fixed income market. So when we think about the overall performance of our fixed income portfolio, it's held up pretty well in 2024. In 2025, some of the noise that we've seen, we wouldn't have taken the brunt of it because once again, the duration that we have is not as extreme as duration can be in fixed income. With respect to the treasury yields, we've seen yields continue to come down. So the green line points to where we were a year ago. Blue line points to where we were as of November 2024. And we've begun to see a normalization of the yield curve, if not a flattening of the yield curve. So before the yield curve was inverted, meaning that your shorter term rates were extended over your longer term rates, that is not sustainable because that would mean over the long term, it's all doom and gloom. There's not anything worth discounting at a good clip. And then at the short term, to have rates so high, that wouldn't be conducive to strong economic growth or a well-functioning economy. So this is typically a temporary phenomenon, but we saw a yield curve inversion that occurred that was the longest in history post-COVID. I'm going to jump ahead a little bit just to jump into equities as we think about other areas of the portfolio and really the growth engine of the portfolio. So equities had an exceptional 2024, even though December was a month of retreat when we think about the market cooling off. It was an exceptional year, 28.1% through the end of November. And then you think about areas of the market that the talking heads talk about lagging. And we think about the Russell 1000 value. We hear about value lagging, but 22.8%, and that's a lagged asset class. That would be a great result to get all year, every year. So it really just puts into context how strong the market has been. Now, over the short term, we also saw a significant bump up and a significant rally in the small cap market. And going back to the economy, interest rates, forward-looking projections, and then pricing in the election and what could potentially happen, there was a little bit of a rally on the small and mid-cap side of things. So on the campaign trail, the incoming administration was very vocal around tariffs, reshoring of jobs back in the US. And you think about your global companies, these are going to be more sensitive to a trade war, particularly over the short term. You then think about small cap stocks, and small cap stocks, these are going to be more insulated from the global economy. Your typical US small cap stock, around 80% of its revenue is going to be derived domestically. So less of a concern with respect to what happens with a trade war. And then you think about a large cap, mid cap, and small cap company. Small cap companies are going to be more levered, i.e., they're going to have more debt on their books. Interest rates come down. That's a pretty strong tailwind for small cap. And then, for mid cap as well. So as we saw in the month of November, post-election, pretty strong rally for both small cap and mid cap. And those macro factors really describe that performance, that bump in performance there. So we think about the S&P 500 really quickly. I mentioned technology, and we can add consumer, or I should say communication services to that technology trade. So 41% essentially in technology. And then you look at the strongest performance coming in from technology as well as financials. The S&P 500, its constituents, the constituents in that index really did hold up exceptionally well. Let me move ahead a little bit to the non-US equity market. And with the non-US equity market, we did describe some of the headwinds facing that part of the market, particularly a strengthening dollar, and then the prospect of a trade war. So we do see a selling off that occurred in the month of November. And again, the outcome of the US election was part of that reason. We think about the longer term results for the international markets. Longer term results continue to be in positive area, meaning that this is an area that adds good diversification when you think about a long-term strategy. But from a valuation standpoint, we continue to see that non-US FDs have continued to be undervalued because they've not performed as strongly as your US equity market. And once again, technology, the leverage and the lower interest rates that have really driven the US market, albeit other than the last 2 years, have really led to a nice lead for the US versus the non-US when we think about longer term performance. Sector performance for the non-US market really quickly. I mentioned IT earlier, so IT communication services comes to 19%. You compare that to that 41% in the US market. And again, that off the bat explains a pretty significant difference in performance across the two. So with that, let me jump into portfolio performance, and also happy to take any macro questions or economic questions that you may have. Also, we can wait till we've gone through November to talk about broader thoughts around the market, movements in the market. But really quickly for the month of November, make this bigger as well. Really good results for the portfolio, 3.7% versus 3.2% for the month. For the quarter, also a solid result, 7.7% for that fiscal year number. And then going further out to the right-hand side, we continue to see really good performance relative to the index. The portfolio is in blue, the index is in gray. Where we've been overweight on the equity side, US equities, that's helped. Even on the non-US equity side, even though it's lagged the US side, that's also been helpful. And then fixed income, even though we're in line with policy, a little bit underweight when we think about fixed income, just given the relative upswing in the equity market and the outperformance of the equity market, both US and non-US versus fixed income. So as we look at the performance of the composites, no surprises here. As we mentioned before, you look at your aggregate fixed income. This is your market duration fixed income. Barksdale holding up in line with the index. Fiscal year to date up 3.7, year to date up 2.9. We think about the MetLife portfolio also holding up well. The investment grade strategy, where you're looking at a 5% result over the year to date period. Garcia Hamilton, this is a manager that's made a pretty sizable duration bet. It's extended its duration relative to the index. So rates coming down in November, pretty strong tailwind for Garcia Hamilton. What we'll see in December, I should say, would be some mean reversion in this strategy. In December, when those inflation numbers came out and then yields ticked up, we did see managers that were extended on duration give back a little bit. So Garcia Hamilton, very good long-term results. Over the short term, though, we've seen a little bit more volatility, really, as duration and interest rates are closely tied with each other. And again, as we previously discussed, the market's been very reactive to macro news and how that can bode for yields and where interest rates are going. Sky Harbor, this is high yield, so high yield performing or having more of a correlation with the equity market. So you're looking at high yield coming in with a very nice 8.7% result. This is one of your more conservative managers, so it's not going to capture all of the upside when you think about where high yield can go. The good news there is it's not expected to capture all the downside as and when we see any mean reversion or resetting in high yield. On the equity side of things, we see Rumline, Northern Trust performing in line with the index. PineBridge, we have a memo that we'll go through momentarily on PineBridge. This is a manager that's done a pretty good job in terms of providing a little downside protection in your more volatile market environments, and then it's rallied with the market, but perhaps not to the same degree in a month like November. So over a cycle, you're looking at performance that essentially approximates the benchmark, but with less risk, with less standard deviation. Copeland holding up pretty nicely when we think about their overall performance. And then Rumline also performing in line with the index. With Copeland, you're looking at a manager that's going to lean a little bit more quality. As we saw core value growth, your core and your growth are going to outperform in an environment like November and calendar year 2024. And then with Acadian and with Ernest Partners, we had a pretty good chat at the prior meeting regarding how these managers would fare in a more volatile environment. And you can see that, while the market was concerned around tariffs, trade wars, and so on, the higher quality nature of these portfolios did not lead to a sell-off relative to the index. So Acadian up 2.2%, benchmark down 90 basis points, Ernest Partners up 50 basis points, the benchmark down 90 basis points, and then Rumline, the index exposure, that was down 70 basis points. So all in all, November was a really, really solid period for the portfolio. And then as we jump into December, very quickly, I'll just give you a quick overview of December performance. The market was down for the month. Year to date, really solid results, however. So while the market did cool off a little bit, year to date, we're up 25% for the S&P 500. The international markets did give back a little bit more following the sell-off in November. So we saw a 5.5% result for the ACWI ex-US. The strengthening of the dollar continued, where we compare that 11.3% result in foreign currency terms to that 3.8% result for the core index. And then as we think about core value growth, we definitely see that growth led the pack. Value came in with very respectable numbers, but they really paled in comparison to what the growth segment of the market was able to do. So 33.4% for large growth, 22.1% for mid growth, and 15.2% for small growth. And then as we look at fixed income, those December numbers were, exhibiting the volatility of rates going to stay longer, higher for longer in 2025. So we did see a cooling off in many segments of the fixed income market. An area that was a little bit more immune to that was the bank loan segment. Bank loans are one of the few areas that will have more of a positive correlation to rates going up. And then,
Yes. I say you see that right there with that yield curve really just showed you the difference between end of November and end of December, blue to the black. So as the rates came down in the short end quickly there, but then went up considerably across the curve, and that's why you saw a lot of negative returns in fixed income.
Yep. Okay, and then we'll go through December performance. And December performance here, we're looking at the portfolio down 2.5%, a little behind the benchmark, but for the quarter, some nice downside protection coming in. So portfolio was down, index was down 1.4%. Continue to see a very healthy fiscal year to date number. And then across all other periods measured, really good performance relative to the index from a tracking standpoint. And then the managers that we just went through really quickly, again, no surprises from a performance standpoint. I'll mention here Garcia Hamilton once again, as Lee mentioned, when we went through the exhibit on the yield curve a short while ago, you saw that rates spiked up very quickly at the short end to intermediate end. And you'll see that, Garcia Hamilton being longer duration gave back some of the gains that they saw throughout the year. But no surprises once again on the fixed income side of things. High yield, that's been a really good diversifier when we think about just dampening some of the noise that's come from the investment grade side of things. On equities, we continue to see equity performance in line with expectations. PineBridge performing in line with the benchmark. So again, not giving back more than the index during a sell-off. That's been pretty consistent when we look at their performance in both up and down environments, particularly in up environments that are more speculative in nature, and then down environments that are sudden and pronounced. You see here Copeland, for example, performing a little bit behind the benchmark, but again, core value growth. We did highlight that the quality components of the market weren't necessarily recognized in calendar year 2024. Rumline small cap continuing to track the index. Acadian and Ernest Partners continuing to provide that downside protection relative to the benchmark. So all in all, no surprises in the portfolio from a performance standpoint. Now, we do have a memo to go through, which represents or goes through an organizational change with one of the managers in the portfolio, PineBridge. So we can dovetail into that. But let me pause really quickly, see if there are any comments or questions, and then we can then move to the next item.
Waco, I just had a question about emerging markets. When you were doing your market commentary, you talked about emerging markets giving good diversification. I agree with that. On the year-to-date returns, multi-asset class year-by-year chart that you always provide, I have the prior months, but it doesn't matter. I think it's pretty consistent. Emerging markets year-to-date are doing pretty well. But when you look at the 10-year period, they're always towards the bottom, at least the last handful of charts. So there's 12 different asset classes, and I think they come in number 10. At least through the end of October, the annualized return was 3.4%. And
Yep.
I'm not criticizing the return necessarily, but Chris and I talk about this from time to time, whether it's international, but more specifically emerging markets. Is there a 10-year period? Is there a long-term period somewhere that you can show us that illustrates the benefits of the diversification into emerging markets and how that diversification has benefited the return versus, for example, U.S. equities?
Yeah, absolutely. So I would say the 90s and then also during the global financial crisis, those would be periods where emerging markets did benefit investors tremendously and more consistently. Now, you raise a really, really good point, Fran. So if we look at the EM index, just as an index, it's been somewhat disappointing to say the least, right? And we think about the constitution of EM, it's basically China and Taiwan at this point. So you think about 40% plus of the index in one sizable area of the market. And as a result of that, one bad period of performance from China, one misstep from China can all of a sudden downplay a pretty promising story. The other thing that we've seen is the continued prominence and the rise of the US dollar. So the global economic system, for lack of a better term, has been somewhat destabilized post 2008. The global financial crisis, the US really led the pack in terms of recovery. And that just led to more dollars and asset flows within the US. The technology story that we just described, the US is leading the pack on that. So I would say that right now, the US holding up so well has also been a relative detractor. And then interest rates going up. EM economies are typically more sensitive to interest rates, particularly as some of these countries will be net debtors to the US. So with rates going up as quickly as they did in 2022, 2023, that would have also eroded some of the returns. But if we look at EM and we think about active management, and then we think about the ability of certain managers that can navigate, and I'll put Acadian down there once again as a good example of that. There's opportunities to still outperform. DFA is another good example. Opportunities to outperform from the active manager story side of things. But as it pertains to EM as an asset class, there have definitely been some pretty strong headwinds. You've got Brazil, Argentina fell out of the index. So a lot of stories to point to. But again, we can go back and go to some data and point to times where EM has really, really lived up to its promise. And then again, kind of highlight through some of the macro points just made now why EM has seen a cooling off in return. So we can definitely follow up with that.
Yeah, it would just be interesting to see. And I know we're in it for diversification, and I get that, and I fully support that. I did think it interesting you stated that 40% of the emerging market index was China and Taiwan. Which is interesting to be diversifying with such a consolidated index. But putting that aside, when does China graduate from the definition of emerging markets, by the way?
Yeah, when MSCI decides, I would say
that was almost a rhetorical question. But yeah, it's interesting. Thanks, Quaco. And one other thing, when and I guess Copeland is a dividend fund, but it's a dividend growth fund. So I get that. But when would you expect the more traditional dividend funds? I guess I'll call them the more defensive funds, right? The quality stocks. When would you expect them to perform well?
So I'll tackle this and then kick it to Lee, but I would say right now, just because rates are coming down and the present value of that strategy, right? The consistency of that dividend income, it's suddenly going to be recognized more by your typical investor. So we've gone from this weird environment where Nvidia just pales everything, right? Nvidia is going up 300%, and everyone's like, "What's a dividend? What's a cash flow? We don't need that. Let's go with the appreciation." But all of a sudden, when rates come down, jitters are there around the economy. All of a sudden, your dividend-paying stocks become that much more attractive. So that's what we would expect in this environment, particularly as we've seen more volatility in the month of January. But Lee, anything else you want to add or kick to that?
No, I mean, you hit the nail on the head from an absolute return point of view, but from a relative return relative to the bench, why you've seen some lag from that recently is the nature of their fund because of buying the dividend growers. They tend to be a little more higher in market cap than the bench, and you saw a small cap, at least in the beginning of Q4, went on a tear on the expectations of rates coming down, etc. They also tend to lean you more to the financials and the value area of the market. So again, as Kwaku's shown you through the quarter and year, value did underperform growth. But yeah, I'm pretty confident in this environment we've seen so far in 2025. It's probably likely they've been ahead. But we can go and look at that with them after this call.
Well, no, I appreciate it. Thank you. I was always curious about that. Thank you.
Okay, so this would take us to the last agenda item, and this is regarding MetLife, the insurance company MetLife, and their acquisition of PineBridge, an existing manager in the portfolio. Generally speaking, I would say MetLife has been on a acquisition tear. This is not the only acquisition that's been announced recently. So they've also acquired the liquid or traditional business of Mesirow, and that was to the tune of $6 billion in assets for MetLife. So when we think about insurance companies, and again, it's pretty cool having these discussions with you guys because we always go back to the connections and how things are linked. So we just spoke about insurance companies, and you think about a MetLife, their book has typically been fixed income up until this point, just because insurance companies, their bread and butter is managing duration, liabilities, and so on. But recognizing the asset management space and understanding that, products need to compete with other products. You can't just go and rely on fixed income in this day and age. You've seen MetLife as well as other entities go out there and look to diversify their book. And in diversifying their book, they've acquired more U.S. equity strategies as well as global strategies. Again, diversifying the revenue stream and business lines, particularly just the awful period we've gone through in fixed income. It must be, if you're relying on fixed income right now and you look at the returns, you think about performance fees, it's probably been a pretty challenging couple of years. So MetLife, they've gone into an agreement to acquire PineBridge. PineBridge, we see here the terms of the deal with respect to $800 million in cash and $200 million subject to certain targets being hit. So basically $1 billion when we think about the transaction. That would give MetLife an additional $100 billion in assets when we think about their book. And as we think about the U.S. research enhanced core equity strategy, this is a strategy that has, again, exhibited good periods of performance when the market has sold off. When the market's been extremely bullish, it's a lower beta strategy in the sense of it's looking at metrics, it's looking at signals, so it's not going to ride, the trend of the market as strongly as, some managers. So the performance has been very, very consistent. And then ultimately, as we think about PineBridge's returns, we continue to think that they are a manager that's made a case to remain in the portfolio. However, because there's a material organizational change, they've been acquired. MetLife will be putting them under their banner. Procedurally, we are recommending placing them on alert or on watch. And what we are looking to do here is over the next 6 months or so, continue to just see that, the team remains in place. Whenever there's a transaction, you want to make sure that assets are growing and assets aren't leaving. While this is a big strategy, there is a pretty healthy concentration of assets with one client, and we just want to make sure that PineBridge is continuing to do what they are needing to do to maintain, that large client account. So all in all, we view this acquisition as a positive because they are joining an organization that really wants to grow its equity business. They really want to make sure that they are putting their equity expertise front line and center. There's other distribution channels such as the defined contribution space. There's the international channel. So this is a huge opportunity for MetLife. So this is all in all, viewed as a positive from a resource standpoint for PineBridge and so on. But with that being said, once again, we want to make sure that we're being very thoughtful about monitoring asset flows. We want to make sure that all the key people, particularly the lead PM for this strategy, they remain in place. And ultimately, our goal is to continue to report to you on a periodic basis on assets, on the timing of the deal, and then ultimately, if there's any questions you guys have along the way, we'll happily give you an update. So the recommendation from Marquette's end would be to place this strategy on watch, and then we'll continue to update you on how the transaction's going and how the assets of the strategy are moving.
Chris, do we need to do anything to put them on watch or no?
No, I don't think, I don't think so.
Okay, thank you.
We already, no.
Could I just ask a general question? When the meeting initially started, there was a discussion about the insurance industry, how it has been impacted by what's going on in California. So can you tell me what the logical conclusion might be, how it might impact the total U.S. insurance industry?
Yeah, I would say that we can probably expect premiums to continue just to go up across the board. You think about your typical insurance company or healthcare company, right? It's a pool, and then ultimately everyone pays into the pool, and then as and when a hazardous event happens, there's a payout from the pool. So for those that have insurance, which is literally everyone across the country, these companies need to maintain certain margins, certain targets, and as they will be paying out due to the fires, we don't know to the extent. We are expecting at the end of the day premiums to go up across the board. I think inflation is one of those weird phenomenon that it catches, whether it's food, whether it's gas prices, but then even your premiums, there's going to be an inflationary aspect there.
Yeah, it's not just the recent fires done the last few years, the drain on FEMA with all the hurricanes as well.
Mm-hmm.
Yeah, I mean, we've just seen a huge trend up over the past 3 years with insurance premiums.
So when you look forward with the new administration coming in and their philosophy in terms of tariffs and that sort of thing, and looking at Greenland and Panama and all of that, what do you think the impact is going to be on the economy? Let's say for 25.
Yeah, I mean, I would say for 25, there's definitely going to be clear winners and losers in the sense of this administration is coming in and it's very unashamed in terms of pro market, pro America, pro bringing business back. Very broad, generic terms, but there's absolutely going to be winners in that. No surprise, we'd expect Tesla to do pretty well. We'd expect SpaceX to do pretty well, just because Elon Musk has, he's probably now listening to us because I just said his name, but he's probably got, he's already a smart guy. Now he's a smart guy that has access to legislation, the deals, the deal makers, and so on. National defense, all of a sudden, that could be something that he takes more of a role in. So I think technology companies should hold up pretty well. When we think about the races that we've been in over the last few decades, you've had the arms race, the space race. Now it's the AI race, and whoever wins that will be the dominant player from a global standpoint. So I think tech will hold up well. I think your construction and your hard assets, because you have a real estate president coming in, I think real estate will be, again, a priority when you think about policies that are favorable for real estate development and so on. I think we've been talking about it close to a decade, but hopefully this is the time where we see reinvestment in infrastructure. And I think that this K-shaped recovery that we've spoken about, where you're going to see certain parts of America doing exceptionally well, I think that will continue in 2025 and beyond. And I think in California, the response to California is an example where Speaker of the House is talking about, contingent relief and things like that. I mean, that's a way to also recognize that, look, some people are going to get left behind. They were already behind. If relief is now contingent and it's not going to be expedited, again, this K-shaped dynamic that we have in the U.S., I think that will get exacerbated. So technology, I think will do well. The reshoring of jobs over the longer term, data centers, all those things should bode well for the real estate market, we would think. And then with rates potentially coming down, I think your more interest rate sensitive sectors should do well. Oh, and then energy. How did I forget energy? Energy should also hold up pretty well as you think about, you're going to be less pro-environmentalist. You're going to see more policies that are pro-energy. These are the areas of the economy that we think should do pretty well.
Thank you. Any other questions, gentlemen? Chris, anything you want to say before we bring this session to closure?
I just wanted to mention at the next meeting on March 19th, I'll have a report on the custody bank search. I'm just doing some additional research, working with Marquette a little bit, and in particular going over the finalist fee proposals. So that report will be ready for your consideration in a couple of months, and our contract with the current bank takes us close to the end of 2025. I think it's the end of October. So we still have some time, for that report, and then a decision and the new contract, be it with the incumbent or with a new bank, to get executed. So that's all I needed to mention, Don. Thank you.
Thank you. Thank you all for participating. Is there a motion to adjourn?
I'll make the motion to adjourn.
So moved. Thank you very much. Enjoy your week.
Thanks, everybody.
Lee, I
Take
hope
care.
you feel better.
Take care, Lee.